I'm Andrew Samalin from Samalin Wealth, and thanks for joining us. Now, I know that you stay up at night wondering how the financial products you consume are affected by interest rate. This 3-minute video should answer that question. Today, we're going to discuss SOFR, which is the Secured Overnight Financing Rate. We're going to define what it is, how it's used, and how it affects your finances and your investments. So what is SOFR? SOFR is a benchmark interest rate that is the successor benchmark to the more familiar LIBOR rate. It is a measure of the cost of borrowing cash overnight collateralized by U.S. Treasury securities. And for a multiple of reasons, including accuracy, past scandals, and reliability, the global financial system is replacing LIBOR with SOFR. Now, this impacts roughly $350 trillion of outstanding business of various types. This transition from LIBOR to SOFR should be complete by June of this year in just roughly 30 days. So how is it used? Well, SOFR is used to price the cost of capital. Since SOFR is an overnight rate that effectively risk-free lending in US dollars, SOFR tends to move with the Fed funds overnight rate, which is tied to US monetary policy. So who uses it? Well, actually, you use it every day. A nearly limitless number of businesses need to price capital and make capital allocation decisions relating to risk and return, and they use SOFR as the basis of that math. It is generally presented as a margin product where the lender will use SOFR plus a margin. So for example, if SOFR is 5% and the margin is 3%, the borrower will pay 8%. And that margin is based upon your creditworthiness and other factors. So how does it affect your finances? Well, if you have a fixed rate loan or mortgage, a shift in SOFR won't impact the interest rate that you pay. However, if you have a variable rate loan, and think, ARMs or private student loans, your interest rate could go up or down. And the same would be true for other debt typically indexed to SOFR, such as corporate business loans, commercial mortgages, and variable rate bonds. Now, in the case of an ARM, an adjustable rate mortgage, if it's based on SOFR, the movement of the benchmark determines how much the borrower will pay once the fixed interest period on their loan ends. If SOFR is higher when the loan resets, homeowners obviously will be paying a higher rate as well. And we've been seeing that lately, particularly since the rates have moved from 1.3 last year to roughly 4% on the 10-year. So how does this affect your investments? Well, a change in SOFR will affect your investments. For example, let's assume that a closed-end fund uses variable rate leverage to increase the yield or the performance of the fund. If that cost of that leverage goes higher, then there will likely be a drag on the net returns to you. Why? Because the costs went up. What about in the case of a REIT? Well, if buildings are leveraged using a variable rate mortgage, then the funds from operations will be lower, therefore they will likely have a higher cap rate, which then lowers the value of the REIT itself. And of course, the opposite is true too. Bottom line, interest rates affect your investments and your finances on a daily basis. SOFR is tied to U.S. monetary policy, so when you hear a change in the Fed funds rate, you will see a change in SOFR. This will affect the interest that you are charged and the interest that you charge for products or services as well. If you have any questions relating to this or any other financial topic, please reach out to us at success@samalinwealth.com. That's success@samalinwealth.com. I'm Andrew Samalin. Have a great day, everyone, and thanks for watching.